Welcome to our channel, Learn Now. Today, we have a very important and informative episode for you. We'll be discussing the recent collapses of Silicon Valley Bank and Signature Bank, two major financial institutions in the United States. We'll dive deep into the events that led to these bank crashes, the impacts on the financial sector, and the lessons we can learn from these unfortunate incidents. So, stay tuned and let's get started. To fully understand the situation, let's quickly go over the histories of both Silicon Valley Bank, SVB, and Signature Bank. SVB, founded in 1983, was well known for its strong focus on technology companies and venture capital, while Signature Bank, established in 2001, catered primarily to the needs of privately owned businesses and their owners. Both banks had grown significantly over the years and became influential institutions in their respective niches. However, things took a turn for the worse. In early 2023, both banks faced a series of unfortunate events, including a sudden and significant decline in the value of their loan portfolios. This was triggered by a sharp downturn in the technology sector and a surge in default rates among their clients. A series of investigations also uncovered risky lending practices and lax risk management at both banks, further contributing to their downfall. The collapse of these two banks sent shockwaves throughout the financial industry, leading to a decline in investor confidence and a tightening of credit markets. This created a domino effect, as other banks and financial institutions began to reevaluate their own risk exposures and lending practices, further exacerbating the economic downturn. As a result, the government stepped in with new regulations to prevent a similar crisis from happening again. These regulations aimed to strengthen risk management practices and transparency within the banking sector. So, what can we learn from the collapse of Silicon Valley Bank and Signature Bank? There are several key takeaways. The importance of robust risk management. Financial institutions must have strong risk management systems in place to prevent excessive exposure to risky assets. Transparency and oversight. Regulatory bodies must ensure that banks maintain transparency in their operations and are held accountable for their actions. The impact of over-reliance on specific industries. Diversifying a bank's portfolio across various industries can help minimize the impact of sudden downturns in a particular sector. The consequences of complacency. Both banks and regulators must be vigilant in identifying and addressing potential risks in the financial sector. Thanks for watching. See you in the next episode. Bye, smiley face.